All right, I would like to welcome everyone here. Thanks for coming to this webinar. We're going to be talking about the state of the digital asset data. So perhaps not the most exciting topic for all of you guys, but I'm sure we're going to make it as interesting as possible. So this webinar will get started with a short presentation where I'll summarize the kind of main high-level findings of the report that we did. And then after that, we'll have a panel of three speakers. We'll have CEOs from Coinmetrics, Digital Asset Data, and BRD. And then in the end, we'll have a short Q&A session when we'll get to all the questions that you guys asked during this webinar. So keep in mind that you can ask questions during the entire webinar. You can ask questions about the presentation or about the panel to the panelists as well. And in the end, we'll just have the session where we try to answer most of them or almost all of them. One more reminder, we did publish this report on the blog about a week ago. It's a 30-page PDF report. So I'm not going to be able to go through all the findings. It's just going to be very high level. So if you want, feel free to just go on our website and download the full report. And in the end, we'll also link the full report so that you can easily just go there. So let's quickly get started. That's just a very brief overview of what it actually is. So why did we actually want to research data? So I think the main answer to that is that we're convinced that it's actually one of the few subsectors in crypto that are really close to being unicorns and being close to being vastly profitable and making a lot of money. If you think about it right now, the subsectors in crypto that are actually generating meaningful amount of money and that have unicorns, it's basically just exchanges, both spot and derivatives. And then you have hardware manufacturers, so wallets and miner manufacturers, and then maybe some blockchain development studios like Ripple or perhaps Consensus. But there's still not actually that many subsectors in crypto that are profitable, and we think that data is going to be one of them. So that's why we're interested in this, and also all of the researchers at the block, we work with all these products on a daily basis. So we just all find it really interesting. What most people don't know, that it's actually already a really big subsector right now. There are more than 50 companies. So even though the most public-facing are the one like CoinGecko or the more retail-facing platforms, there's actually more than 50 of them right now, and they employ more than 850 people. So it's already a really large subsector that many people still don't know much about. And all these companies have already raised nearly $300 million. So a lot of venture funding as well. And this is just from the disclosed deals. So there's also private funding and some self-funding as well. So we think it's probably closer to $500 million already on the raised amount. And the growth rate is about 33% from 2017 to 2019. So all this is to say that it's not small anymore. It's already a really quickly growing subsector. So in here, we can see the segmentation that we've decided to go for this report. So we can't just throw all of these companies into one bucket, because all of these are targeting different clients, and all of these are servicing a different need. So the first one is the infrastructure providers. These are the companies that are basically providing blockchain as a service, and then just enabling these developers and businesses to build the blockchain-enabled applications. Most of the infrastructure providers are targeting enterprise clients. So some of these investment banks or consulting firms are interested in these services. And the main reason for that is that it's really costly to just run the blockchain itself by themselves. So they would rather hire a third party to just do it for themselves and save money for that. Then we have on-chain metric providers. So for example, one of the main companies that most of you guys probably know is Coinmetrics. And so these are the companies that are basically pulling the data from the nodes, and then getting the data to show some insights and analytics across multiple of these nodes. And then finally, perhaps the closest to the traditional finance space is the market data provider, and those are basically the companies that are collecting price volume data from the exchanges that are in the space, and they're standardizing it into one API. So in here, you guys can already see all the companies that are in the subsector. So like I already mentioned, a lot of different companies, a lot of different employees. And when you look at this short chart, look at a small chart, you can already kind of see that it's likely not sustainable that there's going to be that many companies into the future. There's more than 50 companies servicing a fairly small market. So I'll get to this a little bit later, but we think there's definitely going to be some consolidation and some companies just shutting down because they're servicing a small market and there's just simply too many of them. In here, we look a little bit more into detail on the infrastructure providers. BRD Blockset is one of the main ones there. You can see on the right side, you can see the magic quadrant that we made. But if you really want to go more into detail, just look into the report. That's much more detailed. But just very high level. So like I already said, these companies are they're providing blockchain node infrastructure. The main customers are enterprises. They're also developers and hobbyists. The main challenges, and these are the challenges that all of these data providers deal with, is that it's really hard to hire skilled engineers and sustain them. Most of these engineers are costly, and they also have to be interested in crypto assets and data analytics. So it's not easy to find engineers. And then the second challenge is that it's really costly to actually maintain the blockchain infrastructure. So it's not just spinning up one node; it's actually spinning up multiple nodes for multiple blockchains, making sure that there's no downtime, making sure that everything is working, and then the infrastructure is connected. And that's really costly. So it's not super easy to do for small starting companies. And then finally, the addressable market, we think that it was about $50 million in 2019. This is changing this year because there's just more enterprises that are interested in these solutions. So it's likely maybe even going to double this year, but last year was still fairly small, only 50 million according to our estimates. Again, you can find all of this information in the report itself. I'm not going to go over all of this, but it has the funding information, the business model information, and then also the pricing and the target client here for all the providers that we spoke to and that we researched. So then market data. So this is, again, the closest to traditional finance. What they do is that they collect pricing and volume data. They also collect order book data and trade data. And really the biggest service here is that they aggregate it and pre-process it into one API. So if you think about it, there's tons of exchanges. CoinMarketCap probably lists maybe 500 of them. But there's only about 22, maybe 40 that are actually significant and that are actually meaningful to collect data for. And all these exchanges, they have different APIs, and they have very different limits, and it's just really hard to work with all these APIs. So what these data providers do is that they aggregate all of this into one API. And then serve it in a way that's the most convenient. The main customers here are quant and algo traders, hedge funds, investment management firms, investment banks, and also some retail traders. The main challenges against is the data normalization, so making sure that all the different APIs are pulled together and working as one. And then balancing between redundancy and cost effectiveness of the data structure. That's something that we've heard constantly from talking to these companies. The addressable market, we think it's fairly similar to the infrastructure one, about 40 million in 2019. But again, increasing pretty rapidly, but still not that large. And on the right side, again, you can see the magic quadrant, Crypto Compare and Kaiko, and digital asset data as well. But again, if you want detail, just look into the report itself. And here, more information about their business model and funding. And then finally, on-chain data providers. So these are a little bit similar to the infrastructure providers, but they produce insights and analytics, and they also process the data to be more consumable from the nodes that they run. The main clients here, again, are enterprises, but also retail traders, and just regular traders. And challenges again are similar: high operational costs. So something that I haven't mentioned yet is that all of this data is really significant. It's hundreds of terabytes of data, so they need a lot of storage and node maintenance, which obviously costs a lot of money, and then hiring experienced engineers and analysts. And I can speak from my experience here. Just for the block, hiring analysts is almost impossible. It takes us incredibly long time to make sure that they're actually high quality and that everyone is on the same page regarding expectations. So that's that challenge in itself. We heard constantly from these companies, hiring the best people and then making sure that these all these operational costs are functioning. And then the addressable market is actually fairly small. We think it's only about 20 million in 2019. And this is why we believe that a lot of these companies that were traditionally only doing on-chain, that they're now verging into different ones as well. So, for example, Coinmetrics is one good example, and we have Tim speaking here after this short presentation. But they also started verging into market data, just for the time being, until the market grows larger. It's definitely good as another source of revenue to have more sources of income. Again, this is the same summary of the funding and the business models. Everything is in the report. This is, I think, something that's really worth paying attention to. Obviously, you guys all have heard about CoinMarketCap's acquisition, which was reported to be as much as $400 million. So that was really the first main acquisition in the space. And CoinMarketCap in itself is a little bit different than the market data providers that we mainly focus on, which focus on institutional clients or enterprises rather. CoinMarketCap is purely a retail-driven business. So most of their revenues are coming from just running ads. So their main business is just dependent on the amount of page views that they get. And we believe that the main reason for Binance's acquisition was to get access to their traffic and really just use it as a funnel to get new clients and new potential clients on Binance. And then Token Analyst wasn't really an acquisition, or at least there isn't any public information. But just recently, I think about 2 weeks ago, they announced that they're shutting down the company, and that the engineers are joining Coinbase. So we think that we'll see a lot more of this in the future. Definitely consolidation, definitely more acquisitions, and some companies shutting down as well, because the market currently is just small for the amount of companies that are currently in this subsector. And then, kind of to close this short presentation, we think that right now the amount of money that was to be made by crypto data companies last year was only about $150 million, probably anywhere from $100 to $150 million. And so in comparison to financial market data spent, so the more traditional finance data providers like Bloomberg or Refinitiv, they made $30 billion in the last year and the year before, and that was the highest revenue that they've had overall. So the data sector in itself is a really good market to be in, because people are willing to pay for data. The issue right now is that the market is still too small, but all these companies, Digital Asset Data, Coinmetrics, and Blockset, they're in this because they believe that this sector in itself and this space will get much larger, and that the opportunity there will be massive, just like it is with Bloomberg, Refinitiv, and all these traditional data providers. So we believe that there's going to be consolidation. We believe that companies are some of the smaller ones are going to start shutting down or joining other teams. But overall, we're just convinced that the future looks really bright for the data sector. There's demand for this data, and there's more and more institutions that are willing to pay for the data, and we know it's going to continue growing. And like I said in the beginning, we're convinced that one of these companies, if not more, is going to become a unicorn in the next 5 to 10 years. So with this being said, that was just a really quick overview again of the research that we've done. You can look at the 30-page PDF report that we have on our site. But with this said, we'll jump into our panel for today, which is really the main event. We have Adam Trademan from Blockset, we have Tim Rice from Coinmetrics, and we have Mike Alfred from Digital Asset Data. So again, reminder that you guys can ask questions during this panel. You can ask any questions, and we'll go through them in the end. But now I'll give it to Adam to briefly introduce himself and introduce Blockset.
Thank you very much. Thank you, everyone, for joining us. It's my pleasure to be here today. My name is Adam Trademan. I'm the CEO of BRD. Our enterprise product is called Blockset. I'm currently based in Tokyo, Japan. BRD has been in business for about 6 years now and is known for our consumer app, which is an easy on-ramp to Bitcoin and cryptocurrency for general investors. We have about 4 million customers in 170 countries who store about $6 billion in our app. And our Blockset product is our newest product line focused on taking all the knowledge and sort of the technology that we've developed for consumers and making that available to enable other companies to build enterprise blockchain software. So it's a pleasure to be here today. I look forward to everyone's questions.
Tim, do you mind quickly introducing yourself?
Yeah, sure. Thanks very much, Larry. Great to be here with everybody today. Thanks for having us. Yeah, I'm the CEO of Coinmetrics. We're known as an on-chain data provider. We've been building out from what Nick Carter and Alexei started in 2017 as a kind of small startup project into kind of a institutional grade business where we not only do on-chain data, but we also do market data and indexes. And we see this as a good opportunity to kind of meet with the public. We spend a lot of time on transparency and education. A vast amount of our spend goes to what many of you come and use our community data for, and we're looking forward to continue to that. But happy to hear your questions and have a conversation.
Mike.
Thanks, Larry, and thanks everybody. Mike Alfred, CEO, Digital Assets Data. We're a cloud data science company, so we come at this from the perspective of a firm like Bridgewater and thinking about how to build a platform that would allow a quant to build and backtest models and run them, in the cloud. And so we've built tooling to do that. Today we're processing hundreds of terabytes of data across on-chain market and other reference data. We're also partnering with some traditional data firms to bring in equities and bond and other data sets that can help with doing correlations. We work with some of the largest firms in the space, the largest asset manager, the largest hedge fund, the largest trading desk. We've raised about $9.5 million so far, and we are raising. So if anyone on this call is interested in investing, we're going to be out raising. And we think this is a new asset class. It's perfect for the quant investing landscape because there's all this new data that people don't understand. There's all these new venues, and it's a fundamentally technological asset class, which allows for rethinking how you would build a modern data platform. So we're really excited to be in the space.
Cool. So maybe let's get started with something that I touched on in the last slide. Is that right now the market is only about 150 million in size, growing fast, needless to say. But how do we get it to be a $10 billion market? What needs to happen? Is it more on the crypto assets itself to mature, or what's going to be the main factor here? And you guys can jump in, whoever wants to first. It really doesn't matter.
Yeah, so I think the main factor is time. So I think if nothing else changed in 5 or 7 years, this is going to be a $1 billion market. There'll be at least one $1 billion data business that's native to the space. We're already seeing that convergence now. So we've had direct interaction with people like Paul Tudor Jones, who's trying to figure out exactly how to model out the space. We're working with firms like that are traditional firms but are coming in rapidly. At my last company, Brightscope, we sold software to BlackRock and Fidelity and T. Rowe, Franklin, those types of firms, and they're all either in the space now or looking to come in. So I think the key thing to watch is just convergence over time. And I believe there'll be at least $1 billion firm in this vertical in 5 years.
I completely agree. I think what'll help drive and accelerate the time frame that it's going to take is investor education, and a good data source for information is a big part of that. Making people comfortable in building bridges to the mindset they have in traditional financial and equity markets, where they're used to having good, high quality data sources, is a good way to do so. There's also frankly, a stigma to digital assets like cryptocurrencies that's been out there. And those kind of things just take time in order to sort of shy away. I mean, look at what's going on with JP Morgan, where Jamie Dimon was very anti-crypto. And now JP Morgan is making great strides. That only took, about a year and a half. But for the rest of the industry to kind of catch up and for everything to sort of mature, I think we all knew when we got involved in crypto, this is the kind of thing that's going to happen over years and decades, not months and a short number of years, like our friends at Instagram and all the social kind of stuff that's going on out there. So data provides a really good way to accelerate things. Education of investors provides a good way, and trust. Building big brands that engender trust is also a critical part of it.
Yeah, and if I can add in, I think, it's really important, kind of the time frame and the patience. So the front end education point is really important to accentuate, which is we need to spend a lot of our early resources on providing as much free educational data and background as we can afford to. To that end, we look for investors who are patient. They understand where we are in the market maturity and how things are going to progress. I think the other thing to consider when you've got these three kind of sectors that you've identified here is that infrastructure sector in traditional capital markets is about $152 billion actually is the market cap of infrastructure when you look at the overall provision that we're going on. Big data represents about $130 billion in spend. And so our little market data that you kind of brought us down to of 30 billion, we've got quite a large market opportunity for those of us who have come in early. We're having to run this infrastructure, we're having to understand it as a native, as well as translate it from where we're operating to where we want to operate with the traditional institution. So, there's a big opportunity normally in the data world, that I've experienced. There's multiple winners. You usually end up on certain sides of it with at least two sources of data for redundancies, even though we're all building redundant data factories. So, granted, there's a crowded chart you had there at the beginning, but I think there's opportunities for a number of people, and it's always good for the industry to have good competition in at this point.
Do you guys think that eventually these already huge data companies like Bloomberg or Refinitiv, they're going to get involved themselves and build their own solutions, or are they going to be more active in just acquiring some of these companies? Because some of the companies that I've spoken to more on the market data side, they already said that there has been some sort of interest, and that they expect that they're going to get involved soon. So how do you guys think that's going to happen? Maybe Mike.
Sure. Yeah. So we're in active dialogue right now with 3 or 4 of the publicly traded, companies that cover traditional financial data, and what we've seen is very limited usage. So we have a couple of these companies that are processing some tick data. There's some companies that have a little bit of Bitcoin understanding, but in general, it's very, very early. So we've embarked on a few different types of partnerships along a few different threads, which we think will bring those firms into this space. I think, given the COVID situation, a lot of these firms are not looking to do acquisitions like in the next 3 to 6 months, but certainly in the next year, you're seeing a lot of interest. We are, at least, from some of the large traditional firms, and they're looking for firms that have the DNA of the firms they're used to working with in traditional markets, right? So like if you've been through contracting with JP Morgan or BlackRock previously, then that could take 12 to 18 months even after they say yes, right? And so those large traditional firms understand that, and they're looking for that kind of sensibility with the leadership team, and they're looking for kind of rigor around the enterprise quality of the data sets that the firms are working on. So I think they're coming, but it's a slow process.
I think Mike is right. When companies are trying to get into a new field, there's always the build versus buy, or they're trying to expand product into this space. And I think they look for three things. They look for a great team for sure, because they're now going to be operating in a space where they don't have sort of that internal sort of experience, right? The second thing is they look for customer acquisition. And as Mike said, if you've got JP Morgan or somebody else big out there, that's obviously critical. And then they look for technology. And one of the things that we're seeing quite a bit is that these companies that want to consume the data and they want to get into the space, they're not just looking for the raw data, but they're looking for historical information, and they're looking for sort of this layer of business logic and metadata on top of the raw information that can be used to basically mine it more effectively and more quickly. But the one thing that I think kind of trumps all of this is that if you look at the traditional financial markets, equities, and these types of things, they're really, really large scale compared to what we do today in crypto. And so these enterprise customers demand a scalable solution. And the industry's got to continue to mature to offer these scalable solutions where, you can support, in a B2B2C model, for example, millions of end customers, not just pilot projects and other small engagements that are going on as they test the waters in these new areas, right? So I think that the scalability and the ability to provide scalable data sourcing is a critical factor.
Yeah, and our data is available on all of the major data platforms at this point. We saw it as an important way to allow enterprise customers to ingest our data through the native source. So having run a division at Thomson Reuters, we knew Datascope was an important place to be because people know how to integrate with Datascope rather than trying to connect to Coinmetrics directly. So we've enabled Bloomberg, Refinitiv, Morningstar, FactSet, S&P. We saw that as an important thing. What we're seeing from the development side, and again, having been a manager there, it goes back to the time horizon of return. If I were to go ask for the amount of investment that we're looking for in any one of these businesses in one of those large companies, the turnaround on my return to keep my job would have to be 2 to 3 years. So they're definitely using a lot of us to kind of test the waters and develop and see, how it works. I do think you'll be challenged to see long-term or near-term, a Refinitiv or a Bloomberg running blockchain nodes themselves. That just doesn't seem to fit with their normal MO. Again, I think from a manager's perspective at one of those firms, you're not going to put your career on the line for crypto at the size of market we are right now. For those of us who are all in on this, we're trying to find the right deployment and the right connectivity in order for when those institutions are coming in, that it's there, they can take it from us or from any of their normal distribution partners.
Tim, I think you're right. Like the original crypto companies, they built all their own infrastructure. They ran their own nodes. They wrote all the software themselves. When guys like Bloomberg get into it and traditional financial institutions, they're likely to take advantage of something akin to what was like Web 2.0 technology versus initial web technology, which is why reinvent the wheel and write all that code again. Use products that are designed to help accelerate the creation of blockchain-enabled software. And so that's why I think they're going to embrace, data sources and blockchain development tools like our companies are offering.
So one of the things that we kept hearing from the companies that we interviewed, which was most of them, was that they're growing really fast these times. So end of 2019, early 2020. So what are some of the companies that are fueling this growth? Is it the existing crypto companies, or is it new clients that you guys haven't really interacted with before?
Oh my gosh, like if you look at fintech and traditional financial institutions' careers websites, they're hiring tons and tons of blockchain engineers, and they just can't hire fast enough. It's really tough to find blockchain engineers in general, even for crypto companies, and the good ones are locked up in all the early crypto companies, or they want to work, in more traditional jobs with lower risk and less stigma, for example, and they could become blockchain engineers. But, it's for that reason that I think these companies that are trying to get into the space, they're trying to hire their own talent. That's why what was mentioned before with Coinbase acquiring some company to kind of pull in the engineers and whatnot, that kind of thing is going to continue to happen because finding talent is critical. But another great solution to that problem, instead of just trying to, acqui-hire and find the talent, is to, adopt these type of tools, whether it's a data source or a blockchain API like Blockset, to help accelerate your growth. Basically, you're leveraging the skills and experience of another set of engineers in order to basically, accelerate what you're developing. And you can do it faster, cheaper, and with less risk. So it's kind of a no-brainer. It's sort of like when companies got involved in the internet initially, everybody was doing everything themselves, and then all these building blocks came out. Those building blocks allowed, companies like Google and Facebook eventually, to be created. And that's kind of the phase that we're in right now. And I think it's gonna create this sort of like uncorrelated, asymmetric growth over the next 5 years in blockchain technology as a result.
Another question that I think is worth exploring is, what about the new like CBDC efforts and Libra efforts? Is that something that can fuel growth here as well? Can it translate to the data providers in any meaningful way?
I mean, the kind of broader coverage that those projects get for blockchain and crypto in general certainly help. I mean, what we saw last summer with Libra coming online early the way that it did, and the testimony before Congress here in the United States certainly brought more discovery into the crypto space from people who are looking at it, and maybe some of the new entrants who got more exposure to how Libra was creating a quasi-stable coin with a basket of securities is bringing some more interest in from some of the sophisticated investors. I mean, we ran the Libra testnet nodes last year when it was coming online, tried to keep up with that stuff. Again, from a data company perspective, we see an opportunity and pay attention to a lot of these things. A chain's a chain, and we're happy to read it as long as it's public, because the truth always exists there. But I do think those kind of bigger public things certainly help create the interest in the space. How they end up playing out in the end is, anybody's, idea.
Agreed.
I think you're right. I was just going to say, when we saw the digital US dollar and digital wallets mentioned in the first draft of the stimulus bill, I think it spurned a lot of interest from traditional financial institutions. We got contacted a bunch with interest in, building blockchain apps and getting access to user data, trying to understand the mindset of consumers and whatnot. So whenever there's a national sort of initiative like that, whether it's in China or something multinational like Facebook, I agree with Tim. I think it's good for the industry overall. It brings renewed interest, and it drives sort of, it spurns investment by large enterprises to look into these things.
Yeah, and I was just going to say that it feels like Libra is definitely more of a consumer-oriented opportunity. The things that tend to get our customers interested and new customers interested are announcements like Renaissance coming into the space, like Tutor coming into the space. I hope to see, Co2 and Tiger Global and some of these other firms coming into the space over time. And so the more you hear about Fidelity getting big customer wins and JP Morgan and Goldman actually doing something, right? There's a lot of announcements about things they might do, but a lot of it ends up being rumor and conjecture, not real progress and results. So as you see these bigger firms actually deliver and actually sign customers, that's good for all the data providers.
So obviously we've seen this huge CoinMarketCap acquisition a month ago. So what do you guys anticipate in the future on the M&A side in the data overall? Do you think that more companies will follow suit, perhaps more exchanges, or what activity do you think is going to happen, and if you think this will actually fuel anything?
Yeah, absolutely. So we've been in contact with 3 or 4 firms just in the last 6 months. One of whom was basically doing a fire sale. Actually, one previous to that was doing a fire sale. So we've seen 2 or 3 that were basically running out of steam, and we're just looking for somebody to acquire the assets and people. And now I think there's going to be some larger ones, some firms that got up to 20 or 30 employees that are potentially going to get into that same spot. So I expect a few different acquisitions by exchanges. We've talked to a couple of them. One of them has announced one big one, but also has smaller ones in the pipeline. All these exchanges need to get their business model mix closer to traditional exchanges, right? So 100% coming from trading fees of revenue in the long run is probably not the best business model. You want to look more like traditional exchanges. And so you could think of a lot of these small data businesses as potential data services channels, right, for the larger exchanges. So I expect exchanges to be very active. Anybody who's trying to do trading and compete with an exchange, like you saw Anchorage bought Merkle, right? Like there's this huge convergence happening where anyone who wants to do trading also needs to do lending, right? That also wants to do custody, right? And so all these things are converging, and data as a channel is absolutely critical to serve quant investors, larger investors, trading desks, et cetera. So if you want to attract those enterprise customers in the long run, you really have to be good with data, and I don't think most of the exchanges are today.
I think the exchanges are getting commoditized. They're differentiating now based on pricing. And that's why you're right, Mike, that they're trying to add differentiation, whether it's lending or other products and services. And acquisitions may be a part of that. There's always going to be fire sales, and there's always going to be, the sort of low hanging fruit in the market when there's such volatility, especially in the crypto space, because a lot of companies in the crypto space who are really in the industry, they hold a disproportionately large portion of their corporate treasury in crypto, because typically the management teams tend to be very bullish on crypto in general, which is a really risky value proposition when it comes to sort of the runway for your company and viability and reaching profitability. So you're probably going to find a larger percentage of companies in the crypto space that are going to, have to go down that path, like an acqui-hire or an asset sale. That said, to me, the exchanges aren't the interesting acquirers, because all that really does is reinforce sort of the existing ecosystem within crypto. What's far more interesting to me would be traditional financial institutions and fintech companies, large ones that are consumer focused, whether it's a Square, a Robinhood, a Stripe, or a real, bank, for example, like JP Morgan or Fidelity or Bank of America, Wells Fargo, who decide that they want to get into the space, and they decide they want to do so by acquiring knowledge, brand, trust, and engender trust from consumers and a large customer base, plus the talent of the, engineering, sales, and marketing teams. And I'm aware of several deals right now, actually, that are being discussed in the mainstream that I think are going to perhaps be a catalyst for more M&A over the next, call it 12 to 24 months. If you look back again, and I keep saying it, but in the history of the internet, right, you saw this sort of bubble develop where there was big growth in and of itself in the ecosystem through venture funded and bootstrap companies. And that's what we are today in crypto. But the real sort of growth when, sort of the massive adoption was created was when you started to see huge brands develop and large acquisitions were made. And that really, it takes the deep pockets of large companies who touch a lot of consumers and a lot of eyeballs. And it basically, steers that incredible power towards a new industry. In that case, it was the internet. In this case, it's going to be digital assets, not even just crypto, but digital assets. And I think that's coming. I think it's coming soon. I think it's coming faster than people think. And when you see things like COVID-19 spurning digital assets, when you see China with the digital RMB, all these types of things are just little catalysts and accelerators that are going to push it faster and faster. So those that are providing data and enterprise solutions, I think it's safe to say they're in the right place at the right time. But you got to be smart about how you run the company. You got to make sure that you can survive the ups and downs and volatility that the crypto markets always sort of engender.
Maybe a question for Tim. Is it what about the companies? Some companies like Kaiko or Crypto Compare, they focus primarily only on market data, and they don't do any on-chain data. And then there's some data providers that only do on-chain data, and then there are also some that combine it, like Coinmetrics and digital asset data as well, where you provide both. So is that the trend that we're going to continue seeing, or are there also going to be companies that are just going to focus on one of these?
Yeah, so I mean, I'm clearly bullish on the side of, customers want to minimize the number of touch points they need to have for an asset class. So, they like to see consolidated APIs where they can connect with one firm, they can contract with one or two firms to get the set of things. If you kind of go up into the traditional markets, and one of the reasons why I lean into things like indices is they're great data funnel sales. You want all of the research, you want all the constituent components behind an index, and you want it kind of all from one place. So, if you look at it traditionally, you're a stock exchange aggregator in the traditional world of Refinitiv, of Bloomberg, and S&P. You also are an aggregator of fixed income securities and all of the other things, because some big firms are looking for a couple of very good organizers of the information so that they don't have to go do that. So, I think, the team internally will get frustrated with the number of things we're trying to push out at Coinmetrics, but I think broadly the right approach is to try and push hard and get as much into one and do it well into the right environment so that you can satisfy the customer need at one endpoint.
Yeah,
Mike, do you want to jump in as well?
Yeah, sure. I would just echo what Tim said. That's been our strategy from the very beginning. When we came into the market in 2018, my pitch to investors was there was no way to get on-chain market reference data all in one cloud platform where you could actually write code, build models, right, and do real quant investing using this data, even though the space is actually perfectly created to do that type of work. And so since then, now it seems like everybody's kind of doing across the spectrum. So I don't know if that by itself will be a differentiator going forward, but we're going to continue to invest in going very, very broad and very deep, because what we hear from customers is that's a value add. Because today, most of these hedge fund managers, they have 50 screens open, and there's like 50 lightweight, crappy, tools in a lot of cases. In a lot of cases, the data, they don't even know where it comes from. So they'll use a lightweight front end if they have to, because they don't know anything better, but they really don't understand the provenance of the data, the quality. So we really focus first on the pipelines, the checks on the data, right? The validation, gap filling, to get to a high level of quality, which means, we neglected probably focusing on the front end, but we're catching up there. We're really, building out low latency streaming dashboards that are infinitely customizable and all the things that you'd expect to see at scale. But we really started with the back end because we think that's going to be a long-term differentiator in the space.
Yeah, I think you're right. And the uniformity of a single simple API to access all the information is really critical. Occam's razor typically, ends up being right, and simplicity is the way to go. But I also think that's part of why this report from the block really helps to provide more clarity and kind of formalization to the space, to educate and to give people confidence, and to give them a kind of an overview of the landscape. Because frankly, this is sort of the wild, wild west to a lot of these folks coming from traditional markets. And, where in those markets, you've got research companies like Gartner and Forrester and all this kind of stuff who are putting out these things for years and years. I really appreciate the initiative of the block to sort of lend credence to the industry and to sort of set the tone with research like this, which really helps to inspire confidence, to educate, and to give people, companies, that sense of comfort they need to make great strides in investing and using the data in ways that will drive investment.
Really appreciate it. Okay, so I think we can move on to the questions. So we have about a little bit more than 15 minutes. So if any of you guys still want to ask questions, please go ahead in the questions tab. I'm going to start asking some of those, but you can still kind of keep dropping them in there, and I'll pick some. And if we can't answer all of them, I'm sure you can reach out to most of us and just ask directly. But one question is, what were some of the traditional banks that are right now the most interested to be involved with digital assets and start consuming the data? I don't know if that's something that you guys can share, but that was one of the questions.
Well, I can certainly share because of sort of our role at BRD relative to some of the publicly announced information about customers. So SBI, which was originally SoftBank Investments 20 years ago, which is a large $10 billion public company investment bank here in Japan, is leveraging BRD technology relative to their crypto banking flow. But more important than that, they're very progressive and proactive in the space. Not only are they probably the largest investor in all crypto and blockchain companies by number of total investments, because they deploy billions in venture funds. But in addition to that, they're also very progressive, shockingly so, frankly, for a conservative Japanese bank, to sort of offer products and services to their end consumer retail customers and their corporate customers in the crypto space. So they run their own exchange, they've got their own custodial, non-custodial wallet services, happens to use my company's technology, but they're looking at all sorts of derivatives and swap markets and all sorts of other things for digital assets, not just crypto even. But Ripple, digital RMB, and sort of pseudo or sort of adjacencies to blockchain, if you will. So that's definitely a great example of a major and significant financial institution that's doing this stuff. They also have a big remittance business that uses Ripple technology. So this is real world stuff. When it comes to the US, I think we've all heard that Fidelity is really aggressively involved in these things. And I think the other trend that I'm seeing is that you find trusted audit and tax companies who have large consulting businesses as well, or system integration businesses. These companies, like they say the top 4 or 5 consulting companies are the guys like the KPMGs, the Deloitte of the world and whatnot. These folks are very trusted at the brands. They provide a lot of banking software and compliance and regulatory advising and audit and whatnot. And we're seeing a huge surge in interest from those companies in creating sort of reference platforms and crypto banking flows that their clients, who are major financial institutions globally, are looking at adopting. So I think that is a great way for the crypto industry to sort of build a bridge into traditional financial institutions. And I'm frankly just really excited to be able to say that I'm actually seeing it happen this year.
Another question that I think is interesting with the recent developments, we've seen the derivatives overall just gain much more traction. The open interest is really going through the roof. It reached more than 5 billion just a couple months ago and still growing. And we've also seen some pretty significant options growth recently. So is that something that you guys, Tim and Mike, are seeing more interest for, the derivatives data rather than just spot data?
100%. So I think Skew really pointed the way forward for the space on this. We're working with some of the large trading desks, and they're really only concerned with derivative data in some cases, not because they're not trading spot, but just because they feel like they have that covered in their core infrastructure. And so we embarked about 6 months ago on a major project. It's one of the most important things we've done to basically replicate the same data sets that Skew has, but then allow customers to work with those in more customized dashboards. So rather than just using the off-the-shelf, Skew dashboard, you can actually basically effectively build your own Skew dashboard using all the same data sets. And that's a little bit of a lift in terms of building the schemas to ingest all that data. But the nice thing about this space is all of that data is technically public, at least for now. And so I think that's one of the advantages we all have at this point is we're all ingesting high volumes of this data now while it's still free or nearly free in some cases, although CME and Bakkt and some of these others are charging because they have traditional businesses and they understand how to monetize. That may be the correct strategy, it may not, I don't know. But there's absolutely huge demand. The derivatives market is much bigger than the spot market. We expect that demand to grow. And notably, Skew did raise money and announced they're going into trading. So I expect them to become less of an aggressive data competitor and more aggressive in competing for the trading volumes in that space. And that's good for those of us who are in the space who really intend on being data providers in the long run.
Yeah, I mean, we're definitely getting hit up for adding, I think we're up to 6 derivatives exchanges we ingest, and we are looking at CME and Bakkt as far as connecting to them and having to pay the fees in order to ingest that data, although they would love to figure out how to break their their business model for a lot of us to kind of help get the flow of that information. And then we've been working on kind of other derivative stuff in the hash rate futures market, the observed work, and some other things. We spoke yesterday with a big firm in Ethereum who's trying to look for some derivatives related to Ethereum mining and some other things. So there's some, not quite the probably derivatives you started the question with, but there are some other interesting derivatives that help the broader ecosystem as far as how they can look to hedge problems that they have as we continue to mature.
Quick follow-up question to what Mike briefly mentioned. Why do you think the exchanges are not currently charging for the data almost at all? It seems like a pretty easy thing for them to do just to increase their revenue.
It's a nascent space, and a lot of the think about it, a lot of the biggest name hedge funds are $100 million, right, or $50 million or 200 million, 5 people, right? They don't even have an internal master data warehouse. They don't have the infrastructure in-house. They can barely ingest, basic Bitcoin trading data across 10 different exchanges. There's a few firms like Bitwise that have gotten really good at doing stuff like that. And so there's just aren't enough customers really, right? And it's still a land grab for volume, right? So if you're an exchange and you put up a gate like CME and Bakkt and say, hey, we're going to charge you $5,000 a year, $10,000 a year, you're gonna wipe out 95% of firms that could trade on your venue, right? And a lot of these firms that start at 50 million are eventually going to be 5 billion. Our whole bet is that if we partner with the best quant funds when they're under 100 million, a few of them are going to get to 10 billion, and we'll have been working with them over the full decade, right? And have grown with them. And so as an exchange, it's totally rational to not charge initially, but I think once you've won, like once you have 20 or 30% of the volumes of whatever kind of core customer base you're focused on, then you eventually charge. Now, keep in mind, there's hundreds of venues today. So just like with the data space, probably 80% of the firms in your chart won't be independent entities in 3 years. Exchanges are no different, right? It's been a wonderful business model for the winners, but there are a lot of second and third tier exchanges that really shouldn't exist. And until those exchanges go away and you consolidate down to, say, 2 or 3 or 4 venues like a traditional market, I don't see anyone charging very much for the data.
Yeah, and when they want to invest, so connecting to nodes is one thing because they're unique and designed to be unique, and they have their own APIs. These exchanges shouldn't be so hard to connect to. I mean, we connect to each exchange in 3 separate sets, and connectivity to these exchanges. Connectivity to New York Stock Exchange is pretty straightforward. It's pretty solid. They know when it's going down. When they're changing their API, and I don't blame crypto exchanges for their approach. I would run as fast and as hard as I could to create volume. Trading volume is the most important thing. But the technology behind how they're delivering data just isn't at a varsity level at this point, and they need to start working on standards. There's only a few exchanges that even can spell fix. So they've got a lot of work to do before they should probably be, volume is their key thing. The other thing is the professional nature of their connectivity needs to come up quite a bit. And as I said, I don't blame them. We're big fans of the exchanges. Clearly, they're kind of the core gold for one of our sides of our business. But there's a long way to go in how we get that exchange connectivity from their side up to a certain level. And I'm sure they'll evolve over time.
Tim, I agree with you, and we had a question from one of our viewers who's talking about fake exchange volume, and that causes me to sort of build onto what you said, which is while the exchanges may have now better developed APIs and whatnot, in many cases, such as companies like Binance, they're unregulated, and so trusting information is really sketchy at best. And so I think those who really want to make sure that the validity and of the data and the source of the data is accurate are best to go directly to the blockchains. But it is a real hassle, not just to run nodes. Running nodes is IT, right? But dealing with forks and learning the different APIs as changes to the blockchains happen is really requires a huge investment. And of course, crypto companies have done that, right? We built our bread and butter on that. Exchanges did that for every blockchain they support. But when it comes to traditional financial institutions or these system integrators or consulting management companies, or better yet, companies that aren't even in finance that want to use blockchain technology for completely other things, right? I think they're gonna look to companies that build APIs that unify access to all these type of digital asset technologies into just like one simple API in order to get there, and that's gonna that also provides a more perhaps trusted source by just going directly to the blockchains, than going through the exchanges. The trick is, as I'm saying, to try to manage going to all the blockchains yourself is a real hassle. And so, there's solutions though today, that allow customers to do that without having to reinvent the wheel like we did in the crypto industry. This is how you know that we're sort of at the maturity, finally the next stage in blockchain software and data access is that, tools like from the companies on this panel, exist to enable as a catalyst for these guys to leverage everything we've done so far.
Another question that we've got is if there's any demand that you guys seeing for DeFi data. So obviously DeFi kind of connects both market and on-chain data into one. And there was a question if you guys are seeing demand for DeFi data from some of the institutional clients.
Yeah, the answer to that is absolutely. Particularly the Silicon Valley firms who have all invested in a lot of these protocols, like the makers and the compounds and whatnot. So we saw a big push starting maybe 6 or 9 months ago for a whole bunch of analytics around some of the new protocols, as well as doing like deeper work like Coinmetrics and Delphi and others have done on Bitcoin with UTXOs, but like realized cap for Ethereum, for example, which is a very heavy computational challenge. And so it's one, like Tim was saying earlier, it's one thing to run a node, right? But it's a whole nother thing to actually pull the data off and put it into a format where you can really do the analytical work at scale that you want to do to understand what's actually happening on each one of those networks. And so, yeah, a lot of the firms, even the really most sophisticated firms that have put a lot of money in those protocols, are struggling to really understand the activity on the networks, and that's a real opportunity for all of us.
Tim, do you want to comment on that as well?
Yeah, well, I mean, the question was, are we seeing demand? Clearly, we're seeing demand, and as Mike said, the specificity of what they're trying to understand. I always kind of go back to the fact that if I sell fixed income data to a fixed income analyst, she knows exactly what she's looking for: duration, convexity, whatever. If you drop off a blockchain level 1 set of data to an analyst to ask questions, and I know Mike's been through this with his data science team, like they don't know what questions to start asking. So that's why we've done a lot of contextualization of things. And so then when you get into DeFi, you kind of go into another level of examination. But stable coins, DeFi, we're seeing demand for everything. It's hard to keep the prioritization and the roadmap in a form that everybody's happy with, because we chase as much as we possibly can. So it's a great problem to have with all the new exciting things to do. But as everybody's kind of mentioned, having the right talent on staff kind of allows you to kind of do the things that the market's looking for. So yeah, DeFi is certainly going to be something that's interesting. I haven't seen it from some of the East Coast Wall Street-ish type of firms yet, but I think Mike's right. It's more out in the cutting edge people who are investing in these things.
And if I could just elaborate on one point Tim just made, because I think it's very important. One of the challenges and the reason why I do believe 80 or 90% of the firms, in your chart are going to be gone is that this space, the narratives change like literally every day. So if you built your firm based on what, Larry, the analyst at the block, said he wanted last week, you're going to be out of business next week because Larry changed his mind over the weekend and he wants 3 other things that you've never addressed before, right? And so I think one of the biggest challenges strategically for a CEO in a data business and evolving space like this is to set a course that's far enough out to really matter, and then track towards that without going off track every time your customer says they want some, some chain that's like the 77th largest chain, and you spend weeks doing deep analytics, and by the time you ship it to them, they don't even care about that chain anymore because it turns out they're not investing in it. And so again, like I think it's really important to have a longer term vision here, so you don't get whipsawed around. I mean, obviously, I hope our competitors get whipsawed a lot, right? Because we'd like to win. But I think the best CEOs and the best companies in this space, I can see where they're tracking towards, and in 2 or 3 cases, I'm pretty convinced it's going to work. In a bunch of the other cases, it's clear that they're just jumping to whatever the customer said they wanted last week, and that's definitely not going to work in this space because the ground is literally moving under our feet as we go along.
All right, so I think we're running out of time a little bit, but let's end this with one last question for all of you guys, and that's just where do you think this space is going overall? Not any concrete predictions, but where do you think the direction is right now? And you can kind of answer in any way you want.
I think the entire capital market stack is going to be remade over the next decade. And so one or two of the firms that are in the space today will actually replace in importance a firm like Bloomberg, Refinitiv, or FactSet. We'll see if that's right.
I completely agree. And I think as we see more tokenization of traditional sort of funds and companies and a resurgence in security tokens and security token offerings, which I'm starting to see a lot of, especially in Asia, I think the data associated with those things and the ability to sort of interact with those markets is going to just grow phenomenally. So I think, if I dare say, I think we're all in the right place at the right time. And I think it's going to be a great growth cycle from here. We're seeing tremendous growth this year, despite the global pandemic, across all enterprise type of markets and customer bases.
Yeah, I think the fortunate or unfortunate beauty of data companies is they're countercyclical. They're very good in down and up cycles, and right now our customers want to hear more from us than less when we're cruising along at whatever nice peak. So I do think this space is going to change the face of information provision. We're not only talking to people about, crypto and broader Ethereum mining and Bitcoin mining, but we're talking about compute, AI, computer power. I mean, there's a lot of the fuel of the future that kind of fits in the narrative around how we're socializing data in this space. Long term, we've got a $30 billion capital markets. Can we get a third of that over? Maybe in 15 years, but probably not in the near term. So there's a couple of nice big companies that are going to grow out of this. I think, again, we're all, the three of us who are on this call, feel like we're in the right space at the right time. So, excited to keep it going.
All right. So thanks a lot, guys, for joining and for having this really insightful discussion. And thank you all, the participants, for asking really insightful questions. And yeah, look forward to the next webinar. And thanks a lot, everyone, for coming.
Great job, Larry. Thank you for having us.
Yeah.
Thank you, Larry.
Really
Thank you.
appreciate it. Look forward to next time.